When most founders think about going public, they picture ringing a bell on the New York Stock Exchange or seeing their ticker symbol scroll across CNBC. But an IPO is not a single event. It's a long, structured process that sits on top of a complex regulatory ladder. And here's the truth. Going public is not one path. It's many paths. Companies don't just IPO. They enter the public markets through one of several different tiers, each one with different requirements, different regulatory burdens, and different strategic outcomes. Today, we're going to break down what being public actually means, the three major exchange environments in the U.S., the listing requirements for each tier, the financial, governance, and shareholder standards, what companies must do internally before they ever apply, and why the public markets involve far more than raising capital. They involve becoming a transparent, compliant, investor-facing organization. Let's begin with the foundation. What does it mean to go public? Going public means your company's securities, usually common stock, are registered under the Securities Exchange Act of 1934. Registration means ongoing obligations, annual filings, quarterly filings, current reports, auditor oversight, board governance, internal controls, public disclosures. In other words, going public is not a fundraising strategy. It's a regulatory identity. It fundamentally transforms how your company must operate. A public company is no longer answering to one owner or a handful of investors. It is accountable to all shareholders, regulators, and the market. Before we talk about raising money, we have to understand where companies actually list. The public market ladder has three environments. The U.S. has three main public market environments: the OTC markets, NASDAQ, and the New York Stock Exchange. Each of these has multiple sub-tiers with their own rules. Let's start at the beginning. OTC markets. OTC markets are the public starting point. OTC stands for over-the-counter. These securities don't trade on a national securities exchange like NASDAQ or the New York Stock Exchange. Instead, they are quoted on a market platform operated by the OTC Markets Group. OTC is broken into three tiers. OTC Pink, the lowest tier. This is the most flexible tier with the fewest requirements. Companies here may have minimum reporting or no reporting at all. This makes OTC Pink the easiest entry point, but also the least credible to institutional investors. You'll find three types of issuers here: emerging companies, distressed companies, or foreign companies. Because requirements are low, valuation expectations are lower. The OTC QB, the venture market. The OTC QB requires current SEC or alternative reporting, annual certification, no shell status, and a minimum bid price, usually around a penny to 25 cents. OTC QB is intended for early-stage, growth-oriented companies that want more credibility than OTC Pink. The OTC QX requires audited financials, no penny stock status, no shells, no bankruptcies, strong governance standards. This is the highest tier of the OTC system. It's not cheap, but it provides significantly more credibility with investors and the media. Companies may stay on the OTC permanently or use it as a stepping stone to NASDAQ. NASDAQ, the mid-market to high-market exchange. NASDAQ is the most common exchange for companies that want institutional access and strong liquidity without the prestige requirements of the New York Stock Exchange. NASDAQ has three tiers: the NASDAQ Capital Market, designated or designed for smaller public companies. Typical requirements include shareholders' equity around 4 to 5 million, minimum market value thresholds, stock price requirements are typically $4 per share, 300 plus shareholders, corporate governance requirements, an audit committee, independent directors. This is where many small cap companies begin their national exchange journey. The NASDAQ Global Market has higher financial and corporate governance standards. Companies here are often mid-sized with multi-year operating histories. And then the NASDAQ Global Select. the highest tier on NASDAQ. This is for companies with strong earnings, governance, and public float requirements, often companies approaching mid or large cap status. The New York Stock Exchange, the highest standard. The New York Stock Exchange has the most rigorous listing standards in the U.S. Minimum thresholds include pre-tax earnings of $10 million over 3 years, a $4 minimum share price, 400 plus shareholders, strong corporate governance, an independent audit and governance committee. New York Stock Exchange listings tend to be mature companies with stable financials. So there are 3 main routes to IPO. Companies can enter the public markets in 3 primary ways. The traditional IPO. This is the classical method. Hire investment banks, prepare S-1 registration, conduct road shows, price the offering, sell shares to institutional investors, begin trading on NASDAQ or the New York Stock Exchange. This is expensive and slow, typically 9 to 18 months. Direct listing. A company lists its shares directly on an exchange without issuing new shares. No capital is raised. Existing shareholders gain liquidity. Companies like Spotify and Coinbase use this model. SPAC merger. A special purpose acquisition company acquires a private company. This allows private company to go public without a traditional IPO process. SPACs were popular in 2020-2021, but have cooled significantly due to regulatory scrutiny. Before a company even considers applying for an exchange, it must undergo a readiness process. This includes audited financials, at least 2 years of PCAOB audited financials, corporate governance, an independent board, audit committee, compensation committee, clear bylaws, and governance practices. Internal controls. Companies must demonstrate strong internal financial controls. A shareholder base. Companies must have a minimum number of shareholders and sufficient public float. Legal and operational cleanup. Material contracts, IP assignments, litigation summaries, executive compensation disclosures. Going public is exposing. Everything must be transparent. While most companies start with exempt offerings first, Reg D, Reg CF, and Reg A are not alternatives to going public. They are prerequisites for most companies. A typical capital journey looks like this. Reg D, build early investor base. Reg CF, activate community and customers. Reg A, expand nationally, raise large sums. OTC QB or NASDAQ capital market, begin public trading. Uplist to higher tiers as maturity increases. Very few companies skip straight to IPO. The regulatory, governance, and capital requirements are simply too high. The key takeaway: going public is a transformation, not a transaction. It requires systems, governance, capital, reporting, discipline, and readiness. The exchanges are not the starting line. They are often the midpoint or finish line of a multi-year process.